In case if you are planning to sell a commercial property or a plot, then it is common to have a doubt whether you will be taxable or capital gain tax is applicable when you sell the commercial property. In this video, I am going to solve all your doubts when it comes to sale of a commercial property. And in my previous video on sale of a residential house property, I had given very clear explanation how to save capital gain tax on sale of residential house property. So in this video as well, I am going to give you clear inputs when it comes to saving capital gain tax on sale of commercial property. Hi, I am CA PRITISH BURTON and welcome to a new video on capital gain or taxation series. In order to understand the capital gain tax, we need to understand what is a capital asset. A capital asset, to be very simple, means when you sell a commercial property, a residential property or a plot or even shares or bonds, whatever gain you make is taxed under the head capital gains. But the only exemption that we have in this case is the agricultural property. So when you sell an agricultural property, that is a rural agricultural property, it is not taxed under the capital gains. In case if it is not a rural agricultural property, then it is again a capital asset and it will be taxed under the capital gains itself. So what do you mean by a commercial property? A commercial property refers to a real estate which is used for business activities. Say in case if you are having a shop or an office building which is let out, then in that case, if you sell that particular property, then you will be taxed under the capital gains. Whereas any rent that you receive will be taxed under the separate head, that is income from house property, which I made a separate detailed video already. You can refer the video. So before getting into how to save capital gain tax on sale of commercial property or a plot of land or any other asset which is not a residential property, then first we need to understand long-term capital gain and short-term capital gain. In case if you buy a property and do not sell it within a period of 24 months, then it is classified as long-term capital gains. More than 24 months is long-term capital asset and its sale becomes long-term capital gains. Whereas in case if you sell before 24 months, then it is classified as short-term capital gains. Why this differentiation is important is for the simple reason that long-term capital gains are taxed at the rate of 20%, whereas short-term capital gains are added to your normal income and taxed as per your slab rates. In case if you fall under the 20% or the 30% bracket, then the short-term capital gains are also taxed at the same rates. Now coming to the most important question, how to save capital gains tax on sale of commercial property or sale of any capital asset other than residential house property. We have three options. First one is section 54F, section 54EC, and the other one is capital gain account scheme. So let us get into the first one, section 54F. So section 54F says that in case if you invest the entire sale proceeds from the sale of the capital asset or from the sale of commercial property into a new residential house, then absolutely you have no tax to pay. The most important term here is the entire sale proceeds and not only the capital gains. So that is the difference, and you have to invest in a residential house property. So the time limit for making the investment is 1 year prior to the date of sale or 2 years after the date of sale, or in case if you are constructing a house property, then 3 years after the date of sale of the commercial property. Then you can save the entire tax provided you invest the entire sale proceeds. So now you might have this question, what happens in case if you do not invest the entire sale proceeds but only a part of it in the new residential house property? So in that case, I will explain to you with a very simple example. Say you had bought a commercial property or a piece of land in the year 2010-11 for rupees 10 lakh. And now in the year 21-22, you sell it for rupees 25 lakhs. So first we need to compute what is the cost of acquisition or the indexed cost of acquisition. In the year 2010-11, the cost of inflation index is around rupees 167, and in the current year 21-22 is 317. So by working out, it comes roughly around 18.9 lakhs. So for calculation purpose, we'll take it as 19 lakh. So the capital gain here is rupees 6 lakhs. That is 25 lakhs minus 19 lakhs is rupees 6 lakhs. So now in case if you invest only a part of your sale proceeds, say rupees 15 lakhs and not the entire sale proceeds of 25 lakhs, then it is allowed only to the extent, or a proportionate is allowed as exemption. So here is the formula that you need to compute. So the formula to compute the exemption is cost of the new house into capital gains divided by the sale proceeds. So in our example, the cost of the new house is rupees 15 lakhs because we are investing only a part of it, and the capital gains is rupees 6 lakhs divided by the entire sale proceeds, that is 25 lakhs. So it comes to 3.6 lakhs. So that is only allowed as exemption. So the capital gain is 6 lakhs minus 3.6 lakhs, 2.4 lakh is taxable at the rate of 20%. An important point to note here is that the exemption under section 54 is not available in case if you own more than one residential house property on the date of the sale of the commercial property or any other capital asset. So keep this in mind, you cannot have more than one residential house property on the date of sale of the capital asset. Section 54F is again not available in case if you purchase another residential house property within a period from 1 year from the date of capital asset, or in case if you construct a residential house property, a new residential house property within a period of 3 years. So in that case, section 54 is not available. In case if you do not want to get into the hassle of making reinvestment in a residential house property, then you have a way out. That is section 54EC. Section 54EC simply says that you have to invest the entire long-term capital gains and not the sale proceeds in specified bonds like NHAI bonds, REC bonds within the stipulated period. That is within a period of 6 months from the date of sale of the capital asset. And also, in order to avail the exemption under section 54EC, you have to do it before filing your income tax returns. So in case of section 54EC bonds, you will have to stay invested for a period of 5 years. In case if you withdraw before 5 years, then the exemption that you had got will be withdrawn and then you will be taxed. The exemption that you had got by investing in section 54EC bonds will be reduced from your cost of asset. Now you might have a question whether I can invest in a residential house property and also in section 54EC bonds. The answer to this is yes, you can invest in a residential house property as well, and the remaining balance portion of long-term capital gain what you have is you can invest in section 54EC bonds and avail the exemption and pay no capital gain tax at all. So in case before filing the income tax return, you are not able to purchase the house property or construct a house property as well, then in that case what you can do is invest or deposit the amount in a separate bank account called capital gain account scheme, and then you can utilize the same for either purchase or construction of the house property. So before filing the income tax returns for the year, deposit in the capital gain account scheme, avail the exemption, and then subsequently you can either purchase or construct the house property. So in case if you do not do it, then the capital gain exemption that you have got will be withdrawn. So friends, thank you very much for watching this video, and in case if you have doubt, I'm sure that many of you all will be having many doubts because the nature of the topic itself is like that. So please feel free to comment below and I will be answering each and every question. So thank you very much and stay tuned for more interesting videos on taxation, personal finance and investment. Happy investing.